I'm John Lesky, recently retired personal financial advisor and founder of FinHealth, a tool to guide you to your financial independence. This is the second of a four-part video series on asset allocation. Last time, we looked at the question, what is asset allocation, and then considered why it's important. In this video, we discuss what we regard as the most important decision you, as an investor, need to make. That is, the choice of your target asset allocation. Your target asset allocation is the mix of defensive and growth assets that you are comfortable holding both at and beyond the time you reach financial independence and/or retirement. At this stage of life, you are relying totally on your investment wealth to fund your desired lifestyle, with no recourse to other sources of income in the event investment markets perform poorly. In making the target asset allocation decision, we believe you need to take account of at least three important considerations. They are 1. Your appetite for or attitude to investment risk. Often called your risk tolerance, it's the level of investment risk you are emotionally comfortable with. 2. Your need for risk. That is, what level of risk you need to take to give you the best chance of achieving your lifestyle objectives. And 3. Your capacity for risk. That is, the amount of investment risk you can afford to take. Before discussing each of these considerations, however, I think it's worth explaining that the FinHealth approach to asset allocation is very different to that usually advocated. This traditional view suggests that young adults can afford to take more investment risk than those later in life. It's argued that young adults have time to recover should initial investment performance prove to be poor and/or their personal circumstances not evolve as originally projected. Consequently, the advice is that they should hold heavily growth-oriented investment portfolios. However, as investors approach retirement, they have less time to recover from adverse investment markets. Therefore, they should progressively reduce their allocation to growth assets and investment risk. By retirement, they should achieve a mix of defensive and growth assets that they intend to maintain for the rest of their lives. This thinking underpins target date funds that are popular in the US and becoming more so in Australia. The fund manager reduces the allocation to growth assets to a target level that varies solely with an investor's age or expected years to retirement. The approach implies that there are a number of age-dependent asset allocation targets. Now, in our opinion, this traditional view, and target date funds in particular, are seriously flawed. Other than the investor's age or desired retirement date, no account is taken of individual circumstances and lifestyle expectations. For example, some 45-year-olds may have already maximised their income earning potential in their field of employment. For example, some teachers, investment bankers and business executives, while others have their best earning years ahead of them. Examples, often medical specialists and partners in law and accounting firms. It's unlikely that they should all have the same target asset allocation, despite being the same age or years to intended retirement. The FinHealth view is that there should only be one target. It's the mix of defensive and growth assets you would be or are comfortable holding both at and beyond the time you reach financial independence and/or retirement. Unless your attitude to risk changes, your target is unlikely to vary with age. It's interesting to note that research has indicated that attitude to risk does not change greatly over time for individuals. However, perceptions of risk can vary considerably and are often driven by investor sentiment. Most investors would benefit from improving their understanding of risk perception and avoid reacting to it. As we'll explain in the next video in this asset allocation series, most young accumulators won't be anywhere near their target asset allocation. Generally, given the way we measure investment wealth, they'll be significantly overweight defensive assets. Their challenge is to choose an investment strategy that is designed to achieve their target asset allocation by retirement and/or financial independence, that also gives them the best chance of meeting or exceeding their lifestyle expectations. So now, let's examine the considerations that go into making the target asset allocation decision more fully. First, we examine what we think is the most important. That is, your attitude to risk or risk tolerance. All things equal, most people prefer lower investment risk to higher risk, and most are risk averse. That is, they require increasing units of return to encourage them to take additional units of risk. However, it's very difficult to objectively measure a person's investment risk tolerance. And even if this could be done reliably, what's the link between this measure and the asset allocation choice? The most scientific approach to tackling both these issues, that is, an objective measure of risk tolerance and its implications for asset allocation, that I am aware of, is provided by Finametrica's risk profiling system. Finametrica is now owned by Morningstar, an international investment research company. In the Finametrica approach, your responses to a 25-question survey provide the basis for the calculation of a risk tolerance score between 0 and 100. This score can be compared with a very large sample of previous respondents. The survey questions cover the following areas: making financial decisions, financial disappointments, financial past, investment, borrowing, and government benefits and tax advantages. Respondents are grouped into 7 risk groups, depending on their risk tolerance scores. The higher the score, the greater the measured risk tolerance. The chart on the screen shows the scores and percentages of total respondents that have taken the survey allocated to each group. For example, Risk Group 5 recorded risk tolerance scores between 55 and 64 and comprises 24% of all respondents. The Risk Profile Survey canvasses respondents' preferred portfolios, return expectations, and sensitivity to volatility in the values of their investments. The table on the screen shows the alternative portfolios for consideration by respondents. People tend to choose the portfolio number that corresponds to their risk group. For example, respondents allocated to Risk Group 4 tend to choose Portfolio 4. Unfortunately, the Finametrica risk profiling tool is only available through participating financial planners. However, a copy of a sample report, together with a completed risk profile questionnaire, is available for free download. My experience with the tool as a financial planner was that it provided a far better guide to how a client emotionally cope with investment risk than did their stated perception of investment risk. Risk perception tended to vary with the state of financial markets, and for some clients swung wildly as markets boomed and busted. They tended to want to take more risk when investment markets were performing well. That is, they were happy to buy at higher prices, and less risk when they performed poorly. That is, they wanted to sell risky assets when prices were low. Buying high and selling low isn't consistent with good financial health. An asset allocation more closely aligned with their relatively stable risk profile or attitude to risk, rather than their widely varying perception of investment risk, resulted in a more disciplined, less emotional approach to wealth management. So, an informed assessment of your attitude to investment risk is clearly a major input into the asset allocation decision. But the expected return from an investment strategy structured solely based on your risk profile score may not be consistent with giving you the best chance of achieving your lifestyle objectives. Your need for investment risk is assessed by first examining the extent of any gap between the lifestyle you wish to lead and your expected financial resources available to meet that lifestyle. The FinHealth personal finance software provides a high-level approach to assessing this gap. If a shortfall exists between lifestyle expectations and financial resources, after making all reasonable structural changes to your financial affairs, then the alternatives for closing the gap are to 1. Take more investment risk than initially assumed to increase the chances of achieving your lifestyle objectives, but with the possibility of making things worse. And 2. Modify your lifestyle objectives, that is, work longer or reduce projected spending. The required investment risk of the portfolio most consistent with achievement of your lifestyle objectives may not match the portfolio indicated by your risk profile score. If your need for risk suggests a more risky portfolio, this raises an uncomfortable dilemma. Do you eat well or sleep well? Neither more risk, with more uncertain outcomes, nor a lower expected lifestyle is particularly palatable. But conscious, well-considered choices need to be made. Otherwise, when growth assets are performing well, the tendency is for most people to opt for higher risk than their risk profile indicates they would be comfortable with, rather than pare back lifestyle expectations. However, when the inevitable downturns occur, these people often lose discipline and abandon sound financial strategies. Their short-term desire for comfort and apparent safety jeopardises their long-term lifestyle aspirations. My experience as a financial planner, particularly at the height of the global financial crisis, convinced me that unless your to-be-discussed capacity for additional risk is high, you should never take more investment risk than your attitude to investment risk suggests you are comfortable with. As such, your attitude to risk places an effective upper limit on your allocation to growth assets. Too many people abandoned their investment strategies when the GFC hit because they were carrying more growth asset risk than they could emotionally handle. In panic, they sold growth assets at low prices. They then didn't feel comfortable to re-enter growth asset markets, if at all, until they had recovered or exceeded pre-GFC levels. Their inability to adhere to a sensible asset allocation strategy meant that their previously lifestyle objectives are now financially unachievable. Finally, let's consider capacity for investment risk. While my financial planning experience suggests that it was a distinct minority, there are some people who are highly likely to achieve their lifestyle objectives with an allocation to growth assets which may be well below that which their attitude to risk suggests they would be comfortable with. For example, an investor may have sufficient investment wealth to fund their desired lifestyle indefinitely, even if invested totally in defensive assets. However, their risk profile suggests they would be emotionally comfortable with the investment risk associated with an allocation of, say, 50% to growth assets. It suggests they have capacity to take additional investment risk. The obvious question then is, what for? As a financial advisor, my approach to this was to split the client's investment wealth into two components. A first component, or primary portfolio, that was judged to very comfortably meet the client's lifestyle objectives, was invested consistent with the client's attitude to risk. The excess, or secondary portfolio, was then invested into 100% growth assets. The client was encouraged to actively consider how this excess wealth could be used in a manner that would help both others and give them personal satisfaction. While the client hoped and expected the excess component would grow over time, its variability was less a source of anxiety, as the financial independence requirement was well catered for with the primary portfolio. So, in summary, in this video, we examined three elements of choosing a target asset allocation. That is, 1, your attitude to investment risk, 2, your need for investment risk, and 3, your capacity for investment risk. All need to be carefully considered. But as should be clear, the FinHealth view is that the primary driver of your maximum target growth asset allocation should be your attitude to investment risk. But having decided on a target asset allocation, how do you measure your asset allocation? Particularly when you are some way off financial independence and or retirement. This important issue is examined in the next part of this 4-part series that will be posted in 2 weeks. So, see you then. Please provide any comments or questions below. Finally,